Hi, this is Terry, and we're dealing with Chapter 7. In all of our chapters, pretty much we've had different equations that we're interested in. And in terms of terminology, our first one is receivable turnover, because we're talking about accounts receivable here. And our formula is to take net sales divided by average accounts receivable. Average accounts receivable is nothing more than January 1st balance plus December 31st balance divided by 2. And what we're looking at is how quickly are people paying their bills. So if we've given somebody terms of 210 net 30, and it's taking an average of 28 days, which is what the second one converts to. The first one is how many times in a year, then 365 divided by that number of times gives us days. So if we turn around and keep track of that number, and it's taking 28 days, 29 days, and all of a sudden it jumps up to 42 days, that's a significant issue there that we need to look at why it's taking so much longer to get our money. Of course, time is money, so in this particular instance, what are we talking, 14 days? There's 14 days worth of money that we haven't collected that we could be paying off bills and not paying interest. So those numbers are just something you keep track of to give you an idea of how well the company, how efficiently the company is being managed. Oftentimes businesses then will need money, and so when they do, what they'll do is take their accounts receivable and they'll sell them off. So they'll it's called factoring. So they'll sell them to a company, and there's a lot of companies out there that specialize in it. You can factor with or without recourse. And the idea there is if you factor with recourse and you sell your accounts receivable to company B over here, then they will go out to the individual people and collect the money from them. If it's with recourse, then the issue is any bills that they deem that they're never going to collect, then they give back to you, and you adjust the money there. If it's without recourse, then once you sell them to this company, then whether or not they collect, it doesn't matter. It's up to that company to collect the money. The difference is in the dollar amount they're going to give you. So if it's without recourse, maybe they give you 80 to 90 cents on the dollar, whereas with recourse, you may get 90 to 95 cents on the dollar. So again, it's just a way that companies that want to come up with cash can sell off their accounts receivable to another company that specializes. When you factor and it's with recourse, that constitutes what's called a contingent liability, which we'll study in the next chapter. But a contingent liability just means that the liability may occur, but one more event has to happen for that, for that to be. So that's the contingency. When we move on here to cash equivalents, we'll see that in our statement of cash flows. But a cash equivalent is anything less than 90. Oops, I got the wrong symbol there. Less than 90 days. So if you go out and buy 30-day treasury bills, then what you're going to do is take those 30-day treasury bills and list that short-term investment right along with your cash, so you'll put it in as cash and cash equivalents. Again, we'll see that mostly in the statement of cash flows, which is the last chapter of the semester. The next topic is one that gives students a lot of trouble, and so I'll do my best to explain it here. The idea is because of the matching principle. The matching principle says that we have to match revenues and expenses into the time period that they occur. And so we know when we go out and record a sale, so we record accounts receivable and sales, we know that some of those accounts receivable are never going to be collected. So what we have to do is create what's called a contra account, or an opposite account, a negative account, and estimate how much that's going to be, how much people are not going to be able to pay. So in this particular scenario, I just made up some numbers that we have accounts receivable 100,000 and that we're not going to be able to collect 10,000. So on our balance sheet, we'd show cash, and then we'd show this accounts receivable less the allowance, and then keep on going down to buildings, plant and equipment, etc. Well, there's two different methods of putting this information into your books and into recording the transaction. They both have exactly the same journal entries. The uncollectible account expense, and this is the matching principle that puts the expense into the proper time period. Again, that's tied to all of your charged sales, all your sales on account. Of course, you don't have any default with people who pay cash. If they pay cash, then there's no default. Cash is cash. So these methods are all based on charged sales. Then the allowance for uncollectible accounts, or the old name was allowance for doubtful accounts. That's your balance sheet item, because as we saw up above, that is the contra account here to our accounts receivable. There's two methods of doing it. The first one is percent of sales. So number one is percent of sales. So if you turned around and said, okay, that we're going to have 1% of $1 million. So that's what, $100,000? Is that right? Nope. Sorry, 10,000. Didn't move my decimal right. So we're going to have $10,000. So what we would record is uncollectible account expense 10,000 and allowance for uncollectible accounts 10,000. And we would put 10,000 into our account, right? This is the allowance. We'd put 10,000 in there. We'd have $10,500 as our ending balance. The issue here is because you're using the percent of the sales, and sales is an income statement account, then we don't care what the ending balance is in the allowance account. What we care about is the dollar amount that goes into that allowance. In contrast to that, what we have is something called aging of the receivables. Let me give you just kind of a quick idea. What you do is 0 to 30 days, and you have customer A, B, C, etc., and you put what dollar value each one of these have in outstanding charges. Then 31 to 60 days, and then 61 to 90, and then greater than 90. So you have all these dollar amounts here. Then you total them up, so we'll use sigma as total. Sigma and sigma. You total them up and you say, okay, about 2% of this total will be uncollected, maybe 10% of 31 to 60, maybe 30 or 40%. Let's go 30% here, and then maybe 70%. So the further out in time you go, then obviously the more likely it is that you're not going to collect that money. And with this aging of the receivables, whatever this number totals up in the table, that becomes your ending balance. So, for instance, let's just say that it's $12,000 that we come up with. Then the journal entry is that we would have to put $11,500 into this account. So that would be our journal entry for our debit and credit value, irregardless of what dollar amount that was. So under the aging of the receivables, what you're concerned about is the ending balance. Remember, in the percent of sales method, we put the dollar amount in. We didn't care what the ending balance was. Under the aging of the receivables, it's the opposite, that the ending balance is what's important, and the dollar amount that makes that happen is whatever it is. All right, hopefully that makes sense to you. Then we do this all along, so that's what that little timeline here is, that we're going to record our sales and we're going to estimate this expense. We'll make these journal entries. Then later, somebody here sends us a notice and says that they're not going to be able to pay their bill. They've gone bankrupt. So what we would do when we go to write them off is we would take the allowance account, and let's say that it's $500, and then we would take it off accounts receivable, $500. So if you looked at this and said, okay, what is the net effect of writing somebody off? Let's say that before the write-off, so before, we had $100,000 here in accounts receivable and $10,000 in the allowance. So we have $90,000. Now we just took off $500 of the accounts receivable, so we have $99,500. We just took $500 out of the allowance, so we've got $9,500 in the allowance, and when we subtract that, we get $90,000. So after we write somebody off and before we write somebody off, notice that the dollar amounts are exactly the same. So the issue here is when we write somebody off, there's no net effect to the balance sheet. When do we have an effect on the balance sheet? All the way back up here when we estimate that expense and the allowance. That's when it affects our financial statements. To physically write somebody off does not change the net value of our financial statements. And why does this all happen? Again, because of the matching principle. All right? The next topic then is a bank reconciliation. And with a bank reconciliation, I like to set it up this way, that we start out with the balance per bank and we'll write in whatever dollar amount that is. Then we'll start out with the balance per book and we'll put it here. And then what we're going to do is add and subtract, add and subtract. And the easiest way to think about this is you need to put in the balance per bank everything that you know that the bank doesn't. So you may have put in a deposit in on a Saturday night or a Sunday when Saturday was the end of the month. Well, it's not going to be until Monday morning that they process that deposit. Therefore, that deposit isn't going to show up until the bank statement for the next month. So we've already recorded in our checkbook. What we need to do to the bank balance is add what's called deposits in transit. We've also written a bunch of checks that when we go to the bank, we know that they just haven't cleared. Excuse me. So therefore, we've already taken those checks out of our balance on our books. What we have is outstanding checks that need to be subtracted. On our balance per books, we're going to add anything in there that we didn't know about but the bank did. So the bank's already recorded it up here, such as an automatic deposit into our account. If we do business and people are going to pay us, they may just have an automatic deduct from their account, which is an automatic deposit into ours. So until we get that bank statement, we don't know what that is. So we would take in our add in our notes receivable. Then we'll have a couple common negatives here would be a service charge that the bank charges us for sending us our statement, and then another thing called NSF, which is non-sufficient funds. So we would have originally recorded when somebody gives us a check, we would have deposited that. Later the bank comes back and says, well, that check didn't clear, so we have to reverse it by subtracting it out. And the whole issue is our adjusted balance, and it's just a little bit off my screen there, has to equal the adjusted balance to the books. So adjusted balance to the bank has to equal the adjusted balance to the books. The last, other issues here, everything else that happens, you just have to use common sense. So if you have a transposition error, that you had a check for $986 that you recorded for $968, I mean, you just got to go back and see what you did, what you should have done, and make whatever journal entry makes what you did become what you should have done. The last issue here is anything on this balance per books you did not know, so therefore you have to journalize it and then post it to the ledger. So journalize it in the general journal, post to the journal ledger. When you get all done, whatever this adjusted balances are, they have to match, and that becomes your final cash balance. Notes receivable and notes payable. Your book goes through the explanation. I don't think I need to go through it any more than just to mention, watch the dates on the maturity dates, because with maturity data, notes receivable, notes payable, you have to count it by the days. You make the journal entry to record the payment. Another issue is to make sure that if you hit a end of a fiscal year, then you may have to record an interest payable or an interest receivable, because you're not going to receive the money until after the beginning of the next fiscal year. And you may give a note payable to somebody who knows that they're not going to be able to pay you in 90 days. If 90 days goes by and they haven't paid you, what you do is you would originally put the notes payable on the books and then credit accounts receivable to lower your accounts receivable. Notes receivable. So you would debit notes receivable, credit accounts receivable, and it just switches it from short term to longer term. If, for instance, that they don't pay their bill, then you have to reverse that accounts receivable and notes receivable. You'll also record the fact that they owe you interest, so that accounts receivable will be higher, because you'll also record interest revenue, that you have a legal right to receive that the revenue, the interest that they owe you. So what that does in essence is just increases the accounts receivable once you find out that they're not going to pay it. All right, hope this helps.